Well, I think we can get started here, and again, people will trickle in and join, and we're also recording this as well, so we'll distribute it to our network and your respective networks and marketing channels afterwards. So yeah, let's just kind of we'll get officially started here. I'll just introduce myself briefly. I'm Peter Darrow, managing partner of Happy Wellness Group. This is the second webinar that we've done and wanted to focus on this topic of social wellness and real estate. We recognize as investors, you're constantly being pitched to and kind of asked for money. We want to create a space where that doesn't happen, so that we can have thought-provoking conversations while staying at the right intellectual altitude. So this will be a short program, hopefully a value add. And as I mentioned, we're recording it as well. And we're joined by three incredible panelists and thought leaders in this space, which I'll be introducing shortly. I'll share more about myself briefly, Happy Wellness. I'll share a few slides just to kind of frame the conversation. We'll go into a roundtable discussion, and then we'll do some Q&A at the end. So very briefly, I'm Peter Darrow, managing partner of Happy Wellness Group. Happy Wellness is an investment group and advisory affiliated with Craft Capital, a FINRA member broker-dealer. Our team of partners and advisors support founders, investors, and strategic partners with expert guidance and access to our curated network. We manage a syndicate of over 300 angels, VCs, family offices. We host a lot of private events for our community through Happy Wellness and also the Well Network. Our objective is to de-risk your investment by leveraging our ecosystem, bringing domain expertise, capital, and relationships to drive toward successful exits. And our thesis is a simple one. When you bring the right people together, you can really move the needle and make a huge impact on societal health and well-being. Rob, do you want to mention a few words on just Craft Capital briefly? We have Rob. Maybe.
Yeah. So Craft is, as you said earlier, FINRA licensed full service broker dealer based in Garden City, New York, which is out on Long Island. I've been there since February, and we can do everything from IPOs to private placements, pipes, etc. So proud to be a partner of Happy Wellness.
Yes, thanks. We're proud to have you. So with that, I'll share a few slides just to kind of frame the conversation here. And then we'll go into into a roundtable discussion with our panelists afterwards. So again, this is the second webinar we've done, and we're very excited to host this series for our investor community. So this is actually pretty timely. Let me see if I can. So the Global Wellness Institute, which is kind of the leader in this space, they just released actually last month their report essentially on social wellness, called Build Well to Live Well in the Future. It's based on their first report they did in 2018. And so I think, that's a great place to start, just because they've really are really the leaders in this space. And so they define wellness real estate as built environments that are proactively designed, built, and operated to support the holistic health of occupants, visitors, and the community. And they talk about, I'm not going to go through the whole report or recap the whole report today. We'll send that out to folks as an addendum to this webinar. But they talk about the 6 dimensions of wellness real estate, being physical, mental and spiritual, social, economic and financial, environmental, and civic and community. And kind of those 6 dimensions intertwining with each other. And when we get into just some numbers and some metrics here, because everyone loves numbers, I just thought there were a few data points that I wanted to share and highlight that I thought were significant. So $584 billion is the kind of market cap in 2024, and is projected to double by 2029 to over 1.1 trillion, with a growth rate of about 15% annually. The US has a 41% market share of the global wellness real estate market. And, there's about a 25% premium that buyers are willing to pay for properties designed with wellness features. So clearly you're seeing the value there and the ROI, and we'll get into that with our panelists in shortly. And then just really kind of highlighting the wellness real estate output versus just your general construction. And you can really see the stark difference by region of how much is being outpoured, and how much the construction development is compared to just your regular construction versus wellness real estate. And I thought this slide was pretty interesting to kind of compare. And then, really just laying the business case for investors and why investors should care about this. So, you're seeing residential price premiums of 10 to 25%. You're seeing commercial rental premiums on a square foot basis, anywhere from 4 to 7%. You're seeing, it's yielding faster sales, lower turnover, higher satisfaction overall. And wellness as overall, especially with corporate strategy, is a huge value add for ESG and brand equity, which we're also going to get into. So again, the numbers and the data supports why investors should care. And then lastly, the opportunity here. There's just some interesting statistics that really stood out to me that I thought are significant. 24% of the global population feels lonely. And, when we talk about social wellness and real estate and how we're solving the loneliness kind of epidemic, and I think that's really important. I was surprised to see this as well, about over 330 million adults go sometimes over 2 weeks without speaking to a friend or family member. I was surprised to see that statistic. Maybe people are just so busy working or just kind of isolated in their own bubble, especially post-COVID. About 25% of seniors globally experience isolation, and kind of how these spaces can help our senior community and our aging boomer population. And then also how wellness real estate can rebuild community and connection. And that's something that I think that's a proper segue into our conversation with our panelists. So again, that's just some high level data points to frame the conversation. We have 3 amazing panelists we're really excited to have, and I'll kind of turn it over and let them introduce themselves. We have Eric Solberg, Chairman, CEO of EXS Capital. We have Amar Amdani, co-founder and managing partner of Adapt Ventures, and Nate Klein, general partner of Cistern Ventures. So we're really excited to have those folks. And Ashley, if we can just highlight those individuals, that would be great as well. And maybe we'll just have you guys introduce yourselves briefly. We'll start with Amar, if you just want to say a few words about yourself and what you've got going on at Adapt.
Absolutely. Well, first off, thanks for having me. A little bit on myself and Adapt. We started the firm about 6 years ago now. Started off as more of a generalist tech investing firm, looking at primarily the US market. If you asked me a year ago what real estate wellness looks like, I'd probably talk about Blank Street. That's the closest thing that came to mind. Over the last couple months, we've really kind of dug into the space, and we've been active backers of multiple concepts now. and are getting more and more active. We had an institutional fund that we were initially deploying out of. We now deploy all personal capital out of a family office, and thanks for having me and excited to be here.
Yeah, thanks so much, Amar. Excited. Eric, you want to share a little bit more?
Sure. Thanks, Peter. So I am the founder and CEO of something called EXS Capital, or as we jokingly refer to it, Excess Capital. So we have been around as a firm for 17 years and have always been at the sort of juxtaposition of private equity and real estate. We used to sort of invest sort of private equity style into real estate developers. And that did very well. But over time, we got more and more involved in sort of operating real estate businesses. We did data centers very successfully for a while, and so on. And inevitably, sort of in the pre-COVID era, that led us to what we call social real estate. So by social real estate, we mean co-working, co-living, student housing, hostels, fitness studios, yoga studios, music studios, any kind of sharing economy, tech-enabled, community and experience-oriented real estate. So everything that you've just described, Peter, really is that's our whole world, right? That we believe that we call. So one of the reasons we call this social real estate is because it's sort of the in real life, live and in person, equivalent of social media. But except, unlike the loneliness machine here, social real estate actually brings people together and alleviates things like loneliness. We completely agree with what you've described in terms of, people aren't spending enough time with other people and people aren't making enough connections. And that is a key element of wellness. So we are active in this space, and impacting wellness both indirectly because all of our businesses bring people together, and we think that makes people less lonely and better. But also, a lot of our businesses directly have a physical wellness component. So, for example, we are the leading investor in something called Mad Monkey Hostels. These are the leading backpacker hostel chain in Southeast Asia. And once upon a time, young people would go to this and just drink and party. But more and more, our guests and the founders are much more interested in sort of an active and healthy lifestyle. So we are setting up not only athletic facilities in the hostels, but also contrast therapy, hot and cold baths and saunas. We're putting more, sunrise runs in, more health drinks and fruit smoothies and all that kind of stuff. And creating more sort of sports and activities around all of these things. So we're involved in this wellness real estate from sort of a meta standpoint all the way down to here's your cold plunge ice bath. And I can give you lots of examples of either existing projects or pipeline projects that we're working on. You mentioned older people. We've got a project which is very similar to Mad Monkey Hostels, except it's for wealthy older people, including a lot of widowers and widows who, frankly, need for their sanity and wellness to be brought together and to make new friends and find a community and have, exercise and spas and so on there. So this is a very core topic to our entire investment thesis.
Great. Well, we're going to dive into it. And I appreciate you sharing all that in a second. And lastly, I'll have Nate just share a little bit more about himself and
Great.
sister.
Great. Thanks, Peter. Happy to be here. Eric, I wish they had those hostels about 20 years ago. I might have stayed in
I know,
one.
me too, brother.
So again, thanks for having me, everyone. Good to see you all. I am the founder and sole GP of Cistern Capital, the Wellness VC. I launched my fund last year. I have a background in everything in institutional finance, so M&A, investment banking, hedge fund, private equity, consulting, training, real estate, and now venture. I have a pretty unique approach, overlapping with a lot of these things that have been said so far. But the way that I view wellness and health is through a holistic lens with a couple different layers. The first layer being multidimensional, so not just physical health, but financial, social, emotional, spiritual, intellectual, occupational, environmental. Naturally, that correlates with a lot of the comments made so far on the wellness real estate angle. I'm very fond of the report that Peter was sharing, as I'm an ambassador to the Global Wellness Institute, so I'm very involved with them. And the second layer is the societal impact layer, right? So I'm looking to disrupt the sick care industrial complex, the food industrial complex, and really get at the root cause of all of the health and wellness deficits that we see across society. Have identified a bunch of problems, one of those being the loneliness epidemic that's been addressed, here, and many others. So excited to be talking about this. And I've got a few portfolio companies that are directly related, one of whom I'm seeing on the screen right now. And then I also have plans to expand beyond my current focus on pre-seed and seed stage, typical venture investing into really becoming the broadest investment firm in this wellness space, to include other stages of VC, eventually private equity, which I've had 20 years experience doing, and probably in the near term, something that's very specifically focused on real estate wellness, because of all the things that I'm seeing in the space. So.
Well, I'm happy to plug Saint Sauna and Cold Plunge Concept opening in New York later this year. So we're very excited to be supporting that project as well. And I couldn't think of three better folks to have on this panel. So again, really appreciate it. Let's dive right in here, and we'll start broad and then kind of go narrow. And again, it's very much popcorn style. Whoever just wants to kind of take it. So, in terms of vision and macro trends, you guys already kind of alluded to some of them, but just, I'd be curious to hear, what are some major trends that you're seeing right now at the intersection of wellness and real estate?
Well, if I can start, I think that that really, in some ways, what you highlighted, what Amar and Nate highlighted, loneliness and sort of the atomization of society that is sort of was accelerated or exacerbated by COVID, and is really also kind of a function of just having so much technology in our lives. I think that, real estate by definition is a place where people physically get together, or it should be. And I think that first and foremost, finding what we call social real estate, whether it be ice bath clubs or many of these other things that we've talked about, that can be a way to physically get people together around, common themes, whether it be contrast therapy, whether it be traveling through Southeast Asia. We've got music studios. And that sort of human connection, I think, is the first and foremost thing that can help, as Nate so well put, sort of solve some of modern society's ills. And then, I think, each one of these different elements of whatever the business is can have, different wellness effects. Again, we have a music studio business. People getting together and making music together, I think, is extraordinarily healthy. It's an extraordinarily important part of the human experience. Traveling together, likewise, doing activities, at various stages of your life. We have another business which is designed for global digital nomads. People have this dream that they're going to travel to Bali or Portugal or Puerto Rico, and they're going to live on the beach, but then they get there and they're alone and they're depressed. So, how do you bring those people together and give them a community in those places? So I think that there's so many different aspects that if real estate is thought out with this lens of, wellness, where it can make a huge impact. Because again, as Nate said, you've got to attack, both the mental and spiritual aspects of wellness as well as just health. And getting people together, making human connections, talking things through, finding points of commonality in terms of interest and so on, and then getting people moving, and actually physically better. That's the way to do this, in my view.
Yeah, absolutely. Especially kind of, you mentioned post-COVID and pre-COVID and the shift that happened there.
Yep.
Amar, Nate, any other thoughts on just kind of high-level trends that you're seeing in this area?
Yeah, I'll pick up off of some of what Eric said, and agree with his thoughts as well. But maybe one thing to kind of characterize is the health tourism, wellness tourism, hospitality angle intersection of activating mixed use real estate with wellness formats, right? So instead of having traditional office space, having office space that's attracting wellness oriented companies or people because of the other things that are co-located with that space, right? And
Yep, well said.
and then also doing so in residential or hospitality combinations as well. So you have a wellness hotel, a fitness space, a cold plunge, wellness clinic, a longevity, whatever, all of these things being co-located into a space to activate it and engage, that audience is something that I, seeing a lot of and interested in that sort of approach. And then, the more simplistic hospitality angle is just recognizing the desire and need for more healthy experiences while traveling. I know for me personally, it used to be that people would think about going to the beach and relaxing as their healthy vacation, but honestly, they would go there and they would just drink at the bar all day, right? And so I've never been a beach vacation person. I'm like, how can I go somewhere where I'm either, having experiences culturally in a city or outdoors, hiking, doing those sorts of things. And so now there are many groups, in the boutique space, figuring out ways to incorporate the wellness angle to the travel. And so you arrive somewhere and it's all integrated with the ability to have those types of activities and experiences as part of the vacation. So it's actually a wellness experience as opposed to a, relax and party experience.
Yeah, absolutely, Nate.
I can give you one good example of exactly that, Nate, which we're looking at, a project that we're working on now, sort of at the MOU stage. One of the things in Southeast Asia is, Southeast Asia is one of the best places in the world to scuba dive. And scuba diving, swimming, ocean sports, surfing, these are vigorous, healthy, get out into the outdoors, move. And, people that sort of do these sports tend to turn into very fervent environmentalists because obviously, things like coral reefs are being deeply affected by climate change and global pollution. So people that get into these kind of sports and activities tend to become very much more concerned about the wellness of the planet as well. So we're working with a very experienced management group to roll up, consolidate, and improve scuba-oriented resorts across Southeast Asia. And, it's just exactly what you describe. It's, let's create vacations where people are going to be actively doing something good. They're going to be out in nature. They're going to be appreciating nature more generally. We're going to bring the marine biologists and other experts who can educate them on how important these things are. We're going to bring photographers along to help to create memories of these types of experiences. We're going to try and create an experience that's better, feed them sustainable local, fish and produce. So, here is something that is thematic, that is social and wellness oriented real estate, and is, active and in line with the trends, all the trends that Nate just described. And by the way, we'll have a cold plunge as well.
Well, I think people would love to know what are the most compelling types of wellness real estate deals that you're investing in right now and why. And then also conversely, what are some red flags or deal structures that you're kind of avoiding in this space? And maybe I'll start with Amar. I know you have a lot of different kind of criteria when it comes to evaluating, opportunities in this space.
Yeah, absolutely. So I think in terms of a lot of the newer kind of wellness experiences that you're seeing now, New York is, I think, really emerged itself as the wellness capital in a lot of ways. And if you look at a lot of the experiences there, it's a pretty experiential market, right? I think a lot of folks have tried and tested different things. You have a high density of people, and so you can actually test a concept, whereas a lot of other concepts around the world are really cater towards niche communities, and oftentimes they don't really make themselves well known globally. And so now you see the social component coming in, which didn't exist in COVID, and there was such a desire to interact with one another. And what are you going to do? When you meet, you can go to a bar, you can go for dinner, you can do all the things that have been done for so long. But there was really no experiences built around what the consumers actually wanted, and that stemmed from those niche communities. So I think a lot of interesting opportunities that we're seeing now are a lot of those niche communities being built out. So things around the contrast therapy is obviously the most prevalent nowadays. But I think even outside of that, you see a lot of different form factors in terms of new sports that are coming out of these niche communities and really going viral, like paddle or pickle, and a lot of these more uh, just enjoyable activities that you can actually hear from people and their users that that's actually what they're looking for. For us, we've gotten it involved in a men's health clinic concept, tackling all types of problems from hair loss to weight management, to skin rejuvenation, all types of vitalities. Historically, there was such a strong stigma of men really focusing on things like that. And so, as we're digging into the space, we noticed that 30% of visitors at med spas that were really built for women were actually men. And so it's, what you have at the end of the day is just a complete disjointed experience. So a lot of these experiences have already existed in some sort of form factor. It was just really honing in on finding who that audience is and building a concept around them. I think when it comes to red flags with any new industry coming up so quickly, you see a lot of folks kind of jumping in and creating concepts that are not really authentic to the founder and what they want to build. And so a lot
Kind
of
of
the
well
times,
washing.
yeah, exactly.
Yeah.
They'll put contrast therapy mixed with a paddle court ecosystem with also a matcha bar there, and there's just kind of too much really going on. I think what you really need is focus and knowing who that person is and building around that one demographic that you're honing in on.
Yeah. Yeah. Thanks, Samar. Very insightful. Nate, Eric, would love to hear kind of what are some compelling deals that you're looking at and what are you also avoiding?
Yeah, sure.
Nate, go ahead.
So yeah, I would look at this kind of in two separate lenses. So one is on the VC side and one is on the more traditional private equity side. So on the VC side, what I'm really primarily focused on, if there's not a lead in right to the real estate, like the real estate is not the purpose behind the asset. It's a component of it. And so is there a way to do, scalable, wellness oriented business in a format that is asset light, people light, and repeatable? Just from a venture scaling and investment standpoint, I don't want to be investing in a pre-seed or seed deal that requires eventually hundreds of millions of dollars put into capex, right? To build
That's
out.
what we do.
Yeah, exactly. That's what Erica's for. So, and so that's kind of, one important consideration, right? And so, you know, calling out the Saint example, right? They're a very small footprint format concept, which is what I was attracted to in the scenario of comparing it to other contrast therapy places like a bathhouse, for example, for those of us that are in New York. I mean, they must be spending millions of dollars a year just in rent for how big the space is. And it's like, how many of those can you have that are meant to support thousands of people? You know, once you've got one or two in New York and you've got one or two some other places, like where else are you going to put these things? And so, so that's a consideration, you know, for me, and just kind of drawing the line between what's a VC investable real estate, you know, wellness versus what's a private equity real estate wellness. On the private equity side, it's all the things that real estate investors always look for, right? So is the, you know, is the yield on cost going to make sense? Is this a cash flowing asset by the time that I need it to be? And is there some sort of defensibility or moat around, you know, the location, right? Everybody talks about location, location, location in real estate, you know, tying that to your audience, whether it's hospitality or whether it's for local use, and knowing that somebody can't build the same thing across the street and defeat your purpose for existence, right?
I think that that's right. And just to sort of expand on what Nate is describing, perhaps a slightly different perspective. I mean, we are looking for, you know, we are involved in social real estate. I mean, two out of those three words are real estate. So we are ultimately in a capital intensive business. The way that we address that is that we try to find good operators, right? Whether it be Mad Monkey Hostels or Pirate Studios, or, you know, this Ocean Resorts project, et cetera, et cetera. We find management teams that really know how to operate and activate that real estate, and to build that community, to offer those services, to throw good events, curated parties, et cetera, et cetera. Once we have built that business, or in many cases fixed that business, then we want to potentially buy the underlying real estate in order to control the whole ecosystem and really capture all of the value that we can, not just working for the landlord who's prying over and going to say, okay, well, at what point is this going to fail, or can I increase their rent, or can I just take over, right? But I think so that's one aspect is, you know, what we try to do is make the operators work, and then selectively go after the real estate, especially as we expand and we go into new projects. But the other aspect I think that is worth noting, Peter, in relation to what do you do, and what do you look for, and how do you avoid? I mean, whether you call it social real estate or wellness oriented real estate, or wellness oriented businesses, the rules of business are still apply. There is no substitute for being a clear market leader. There's no substitute for having sustainable competitive advantages. There's no substitute for having a brand or technology, or you know, a leadership position or an expert management team that gives you, you know, a moat, a competitive advantage against somebody doing exactly what Nate just described, opening up across the street. We've looked at, for instance, a bunch of, you know, contrast therapy businesses, and we've never been able to get comfortable with any of them. One, because the entrepreneurs inevitably come to us and say, this is the new hot thing. And we go, yeah, we agree. And they go, and therefore it's worth 20 times revenue, you know, out what we project our revenue to be out 3 times, 3 years from now. And we go, no, it's not. And so we, you know, there's a valuation gap between, you know, them saying, well, look, this is the newest, hottest thing, and us be saying, yeah, sure, but everybody realizes that, and everybody's coming up with this, and, you know, the technology, there's no real branding or business model or technology competitive advantage, whether, you know, you're creating more of a sonic bath experience, or whether you're doing, you know, you're just creating a membership model, or whether it's individual rooms. You know, yes, there's all these different business models coming up, but, you know, how do any of them have sustainable competitive advantage, or technology, or brand, or other types of market leadership compared to the rest? right?
Well, so I guess, Eric, that kind of leads to my next question, and I know Nate touched upon it a little bit as well. When you're underwriting a deal,
Sure.
what metrics or early signals are telling you that wellness is really driving the value?
Um, I think that wellness is only one component of what we are looking at in terms of those issues. Um, we have come up with an analytical framework which we use to evaluate again what we call social real estate businesses. Um, if you like, I can share screen super quickly to show you exactly what I mean.
Sure, sure.
So this is an example of our metrics. We look at for these are two of our businesses, Mad Monkey Hostels and Pirate Studios, and we look at the market, the community, the real estate, and the tech. So in the market, how competitive is this? If it's completely fragmented, that would be kind of a 10 out of 1 to 10. If it's a very big market, that would be 10, right? So Mad Monkey, it's a very fragmented market. It's a relatively big market. So you get a lot of, you get this. If the Octagon was completely filled, that would be a perfect business. Is Mad Monkey Hostel a very social experience? Does it create community? Absolutely, it does. Is there a sharing economy aspect of it? Maybe less so. Is this a tech business? Well, we have an app. We're the only people with an app, and the app really helps us. Are there network effects? Yes, to a certain extent. And then is the real estate opportunity. I mean, we're active in a lot of Southeast Asian markets, where Thailand, Indonesia, foreign funds like ourselves really can't buy the real estate. But we're in markets where we can, like Malaysia, Australia, Japan, we are seeing value because there's not a lot of people that are looking for the buildings that very many, lots of people are interested in hospitality, but not in this sector. So we've created kind of an analytical framework where we look at these different aspects and we kind of create a radar graph, right, if you will, to try and evaluate and communicate to each other and to our investors and partners, how good is this? How good is this an opportunity versus another? Now, this applies more broadly to social real estate businesses, but if we were to look specifically at wellness, we might create another sector that was, is this something that is a flash in the pan trend, like maybe contrast therapy is? I mean, the science is really conflicting on contrast therapy. Is it good for you? Is it not good for you? Is it good for muscle recovery? Does it make you just feel good? People aren't sure yet. Or is this something, or is it an aspect of the fitness and wellness that's really almost permanent? I would argue yoga is forever. Now, of course, my wife is a yoga teacher, so if I say anything else, I will, that's it for me. But again, that's how we kind of evaluate these aspects, if that makes sense.
Yeah, I appreciate you get extra credit for sharing for bringing slides to the presentation.
I didn't mean to, but there
No,
it
I
is.
love it. I love it. That was super
Thanks.
helpful and insightful. Thank you, Eric. And just briefly, Amar, yeah, just curious kind of if there are certain metrics or things that when you're evaluating a deal, underwriting an opportunity, what are some metrics or kind of early signals that you're looking for?
Yeah, so the way we typically invest, we're usually one of the first investors in the company. And I think what Eric mentioned around just being realistic on valuation is so important.
Yeah.
At the end of the day, it is a real estate business. You look at the revenue per square foot, you look at the EBITDA per square foot, look at the payback periods, and a lot of these typical metrics that you're making investments based off of. And if you're investing at CPG or tech multiples, then you're in for a rude awakening.
Yeah. I have two other questions, and then we'll have a few minutes left for any kind of audience Q&A. Just briefly on scaling, once you find a successful wellness real estate concept, how do you think about scale?
I mean, we specifically, again, as part of that analytical framework, radar graph that I just showed you, one of the first things that we look at is, how high do we think the ceiling is for this? So, again, so, again, to give you a specific example, there are 6,200 approximately hostels across Asia. We are the market leader by 3x with 28. That means that there's a pretty high ceiling,
Yeah.
right? We could expand 10x, 20x, and still be a relatively small fraction of the overall market. Likewise, music studios, band rehearsal studios, that's a very mom and pop industry globally. We're globally the number one with 33 locations. Nobody else anywhere in the world comes anywhere close. So again, that implies that that's a pretty high ceiling opportunity. But that's one of the first things that we look at is how, if this is a market that, for example, big box gyms. Oh man, could you build the world leading big box gym? Perhaps. But man, that's a huge slog against, entrenched competition, whether it be Pure in Asia or Equinox in New York or whatever, right? That's tough. So these are some of the aspects of, again, do you have nothing but green grass in front of you? How high is the ceiling? Is this a really big space? If it's not, maybe it's something we're less interested in.
Nate, how are you evaluating scale on the VC side?
Yeah, so some similarities, but differences logically as well. For me, I start baseline foundationally at unit economics. So start with one. What does it do? The initial, the sort of 6 month, 12 month, and the stabilization. Hopefully the stabilization is pretty quick. Hopefully, the startup costs and the ongoing operations and the attached management and people associated with it are limited and scalable. As I said, I'm going to be gravitating towards, in a VC context, those things that are more asset light. So they're probably, leasing rather than building or buying the spaces. But what risks does that entail if that is the case? And how do you kind of manage whether there's an arbitrage that gets competed away, or whether there's some inherent value in the business outside of the real estate, right? For me, on the VC side, it has to be that there's value outside of the real estate if we're not owning the real estate, because we have no residual value to sell if the operating business doesn't work.
Yeah, makes perfect sense. My last question, and then we'll have a few minutes remaining here, are on returns and exit strategy. Kind of two different questions. What are the most likely exit paths for wellness real estate today? Whether it's REITs, roll-ups, institutional buyers, and what kind of hold periods or return profiles are you targeting for these deals? I'd love just to hear your thoughts.
I'll go quickly. For me, it's all of the above from an exit standpoint. Whoever pays the highest price. But the, specifically,
what's customary? What are you kind of expecting?
Yeah. So, I mean, customarily or expectation wise, what I'm expecting is that there is, a larger incumbent out there that is looking to access something new that they don't have in their portfolio of businesses, most often. Or it's a private equity buyer just strictly financially motivated on, and I've talked about this with many of my, real estate associated, four-wall associated businesses, that you've got to make a decision early on whether you're going to own and operate all of your assets or whether you're going to franchise them. And then depending on which decision you make, that's going to change your exit opportunities accordingly. And, the other alternative for the exit is the private equity exit to somebody who has to then see a business plan or a value add to the business at the point that it's sold. So you can't scale it to the max and then expect there to be all these buyers out there. It has to be scaled to a point where there's a logical inflection, such as taking over the US and then scaling internationally with somebody that has a footprint to be able to do that, for example. From a return standpoint, for me, it's, can I return the fund with this investment, right? So like was mentioned before, I'm very concerned about what's the going in value. What kind of multiple on capital can I potentially expect to receive if everything goes gangbusters? And that has to correlate back to if I'm making, let's call it a, $500,000 investment, I've got to make 20x on that to return the fund at 10 million. So there better be scenarios, one or two scenarios that show a return that's greater than that.
Yeah. Amar, Eric, curious of just kind of your thoughts on exit and returns.
Amar, go ahead.
Yeah, the way we underwrite it is typical to like a CPG brand. Oftentimes there's strategic buyers. I think a lot more so. I think with wellness real estate, we'll start seeing a lot more of those strategic buyers come out of the woodworks and start finding value in these types of businesses. You see incumbents like IHG buy Six Senses more for their wellness component rather than the hotel, and that was a clear
Great example.
differentiator for them. And I think it's just very early days. So I think the most safe underwriting exit or acquire would be, a more traditional private equity firm that's investing primarily based on financial metrics and financial returns. But in an ideal world, would love to see one of the concepts go public in some capacity. It might be delusional today, but 5-10 years down the line, we can see a lot of these businesses have really strong fundamentals, especially if they're corporate owned, that could be pretty interesting down the line.
Eric, you've got the last word here on this.
Okay, well, I mean, as I'm fond of saying, quoting the old Monty Python, and now for something completely different. I mean, we're kind of at the other end of the spectrum from Nate, right? We have invested about $1 billion over 17 years. We've never made a 20x, but we've never made less than a 15% IRR on any deal we've ever done either. So we tend to do a smaller number of larger deals, and they all work. At least they have so far. But again, Nate's coming in at sort of a venture or early stage stuff. Often what we're doing is we're rescuing distressed businesses and making them work. So I think that's a little bit lower risk and potentially lower return strategy than what Amar or Nate are trying to do. But again, it sort of suits our nature and everything else. So
I hear WeWork's available now.
Yeah, well,
I'm teasing. We've got one of our Portco members, former. Anyways,
we've looked at it. We've looked at it, and we've looked at 50 other co-working operators. I mean, that is the Mac Daddy of social real estate in a way. The problem is, again, from the standpoint of what we're talking about earlier, it's become such a vanilla asset class that, how do you create a real leadership or competitive advantage in co-working versus when you're competing against Industrious and Justco and GoWork and Hub in Australia and all these things, plus the corpse of WeWork, right? In terms of exits, again, Nate's answer of whoever will buy it at the highest price is, of course, our answer as well. But we think a lot of these things will be bought directly by strategic. I think our Mad Monkey hostel business will be as likely to be bought by Marriott because it's the fastest growing part of, Asian hostels are the highest and fastest growing part of hospitality anywhere in the world. And if you put a wellness component on that, it just adds, more sizzle to the steak. So that's a good possibility. But another possibility is we take all these social real estate businesses, which are really just, in our view, kind of different flavors of ice cream, and you list the whole thing as a Baskin Robbins, right? You take all the operating businesses and list that as an IPO, and you take all the real estate and you put that as a REIT. You staple that together and effectively becomes a social real estate kind of hospitality trust. And so again, the same idea as what Amar and Nate are saying, in terms of you want as many different multiple options as you can get, you know, from selling it to another private equity group to refining it to recapping the real estate only to selling off the real estate to an insurance company for yield and selling the operator company off to a strategic to potentially bundling the whole thing together and listing it as a conglomerate. But and I'm sure in the way that my counterparties here have tried very hard to structure it in such a way, all of our investments and indeed our entire fund vehicle, such that as many of these exits are possible, as we can imagine.
Yeah, all makes sense. Really appreciate it. I promise to try to end on time here, maybe 1 or 2 minutes over. Just want to open it up to anyone. We have about 3 or 4 minutes left here. If anyone has any questions from the audience, don't be shy. Feel free to unmute yourself or either drop it in the chat or just or feel free to just ask our panelists here.
Any of the Ashleys have anything?
I think we have a few name changes. Any burning last minute questions before we sign off for the panelists?
Maybe just a general question, like what's an exciting deal that you've come across lately and why'd you like it?
We're working on one, which is kind of which, I mean, this sector has been mentioned a couple of times, which is retirement living. And we have a partner that has bought a castle and 3 stately homes in the UK. And we are converting that into a community and socially oriented, I'm not sure I want to call it retirement home, but sort of active, more senior living. Think Soho House meets Downton Abbey. So I'm having a lot of fun with that. Yes, exactly. That's right. Maybe with as many ED medications and potential side effects in terms of STDs as that as well.
I have a question for you. How are you thinking about AI and that kind of changing your investment thesis and or how that's being implemented into the businesses that you're thinking about?
Probably better answered by my VC colleagues.
Nate or Amar?
I think these types of business and this asset class is only going to grow because AI is becoming highly technical. And from a consumer standpoint, a lot of folks are adopting it as the fastest rates in history. But I think from an investment standpoint, the valuations are just so out of scope for a lot of early stage investors and growth stage investors. And a lot of times now it feels a lot more like a lottery ticket than a diligence investment that you're making. And so I think from an operational standpoint, I think it'll unlock a lot of levers, especially from like a go-to-market standpoint, content, marketing, and brand building. As well as I think even from an operational standpoint, there'll probably be a whole ecosystem of tools that could create efficiencies and in everything from ops management to staffing, etc. But I think from an investment standpoint, I think this sector is going to get even more exciting due to the binary nature of typical AI investing.
Yeah, I'll quickly piggyback off of most of that. I think it's most relevant to me as it relates to actually enhancing and accelerating the ability of the companies that I have to scale with less people, as being kind of a big benefit. On the side of, does it actually change or affect or negatively impact the investments that I'm targeting? No, I only see kind of potential benefit from it. But also piggybacking off of the valuation play, yeah, I'm investing at 50% below the market valuation levels that are being pulled upward by the AI deals, but not so much because I'm looking at the medians as my reference point. That being said, if you're leading with AI and you have nothing else, I'm walking away. If you have something else and you're making it better with AI, I'll listen.
I very well said. I would agree with that completely.
Well, on that note, we're about 2 minutes over. I was going to let Jeremy Levinson of AllianceBernstein have the last word. I think he had to pop off, and we're probably going to start losing people now. So again, Nate, Eric, Amar, really appreciate your time, your insights. This was super valuable, really helpful, and hopefully it was mutually beneficial and interesting as well.
Very much so. Thank you, Peter, and happy wellness team, as well as Amar and Nate. Great to meet you guys.
You too. Thanks, everyone.
Yeah,
Thanks
Be well.
Thanks for curating this program. We appreciate it. Thanks, everyone.
Thanks.
Cheers.
Yeah.